Good morning, traders. Chris Bus here with Traders Profit Compass with another edition of Before the Bell for Monday, October 3rd, first day of Q4 trading. Hope you guys had a nice weekend and everything. Don't forget to run your player at 1.5x. I think you'll like that speed. First, a couple of notes before we get into the charts. I want to give a big shout out to Brian and Mark. I received a couple of really nice donations from them last week. I wanted to tell them I really appreciated it. And if any of the rest of you want to make a donation to the channel, you can find the Buy Me Coffee link in the show notes on the video and also on all my daily emails to you. That would be great. Anything is really appreciated. Also, I want to tell you, like last week, I was very distracted with the hurricane, and not because there was any material impact to me. I mean, very minimal, basically a nothing burger. But what I wanted to tell you is, if you've been around my work, you know I was at ground zero for Hurricane Andrew back in '92. Basically took a complete wipeout, and quite a number of other storms. South Florida was really active in the late '90s and early 2000s. Quite a number of hits and side swipes and stuff like that. And whenever you go through something like that, I think there's an element of PTSD, that phenomenon where if you were in war or some other event like that and you hear a cherry bomb go off on New Year's Eve, you hit the floor and you roll under the bed just as a reaction, because you've been conditioned to do that. So last week, even though there was no material impact to me, all these emotions of stuff that happened and, what if it turns and all this other kind of stuff come rushing back in, and very hard to focus on stocks and stuff like that. So I'm hoping that this week all that stuff has passed and get back to providing you some really good information. But anyways, okay. Oil's up 4% this morning. Nat gas down about 3%. Most of the indexes are relatively flat. I did notice Tesla's down $15 this morning. I know there was some news over the weekend. I did not investigate it. Might have been production numbers, some stuff like that. Also on the macro front, OPEC has called an emergency meeting of their members to meet face-to-face in Vienna. Sounds kind of important. Ever since COVID, all their meetings have been virtual, and now they're calling an emergency meeting and face-to-face to meet in Vienna this week. You'll have to go online to find the exact date of that. I don't have that handy. But like everybody else, they've seen the price of oil dropping, and I guess the scuttlebutt is they're going to make a production cut of up to 1 million barrels a day. But keep in mind that the OPEC countries have not been meeting their production quotas for a long time. So for them to say, okay, we're going to cut our production numbers by 1 million, actually on the ground, nothing is really going to change. I think the biggest changes that are going to be happening is when does the SPDR releases wind up? We got about 6-7 weeks before the election. I think those will wind up towards the end of October, and then we'll be faced with a decision, when and if to start refilling it, and then what the demand picture is going to be with a global slowdown seemingly underfoot. that's going to probably be a bigger driver of oil prices. So what I'm going to do today is run through how we finished up last week. There have been some developments on the weekly charts, so I want to show you that. So let's dive right into it. Here's the strong dollar. We did have a down week for the dollar. You see, we got into the high 114s, and now we've pulled back into that 112 area. I think you'd be looking for support between 111.50 and 111, right in here, right where this 20 EMA comes into play. I think the dollar is still getting safe haven bids from, if you look at all the other currencies, really, mainly the euro and the Japanese yen, the dollar has been dominating, and I don't expect that to change anytime soon unless there's some kind of big, coordinated effort to bring down the dollar by those big central banks. And of course, we won't know when it starts, but we'll see it in the chart. So keep an eye on the dollar. What I've done here on TLT is give you the weekly look, because last week we were at a critical point right here at 105, and you can see that 105 line goes way back into time to create this value area between 105 and actually more towards 104 to 117, right in that area, creating a $12 to $13 wide trading range. And so now we've broken that. So from our TA 101, when you break a well-defined range, the measured move is the width of the range. So if you take $13 from 105, that's going to put you down in the low to mid 90s. And you can see that we've got a support level here at 97.50. The door is definitely open for that right now. But if that were to break, then you're looking at going down into the low 90s on this measured move basis. So I would be keying in on 105 as a level to recover on any kind of a bounce or reversal, and then also 97.50 as a support area where you might see some buyers step in. We do have positive divergence. If you notice here, we've got positive divergence on RSI and PPO. We made a lower low, but a higher low on RSI and PPO. So, but right here in the middle, where are we at? 102. I mean, you can go down to an hourly or daily chart to refine the levels, but just from the weekly standpoint, the door is open for lower, and I really don't like the fact that this long-standing value range has broken. So normally what happens is, price definitely has a bias lower until something changes. On our VIX, still hovering in the 30, 31, 32 range. Very tough to anchor yourself to any longs in this situation, simply because we're above VIX support, which would come in down here at 30.29, and the door is open for a flash move up towards these prior highs towards 36. So if you've got tactical longs and you have a short-term time frame on your matrix and you see the VIX falling and TLT rising, then you may have a good tactical long. All I'm saying is taking big swings on the long side strategically here, I think is fairly risky. What you want to see is a break to the downside through this support area and lose this channel, and then you've got an open door for lower and lower VIX prices, which would be supportive of higher prices in equities. So here on Bitcoin, fairly remarkable that this 19,000 has not really broken yet. We've had some probes down into the low 18,000s, but obviously it has not broken yet. So, I mean, support is support until and unless broken. So, I mean, everybody and their brother knows this line. So that makes it even more important. You can see back in time a lot of little fake moves below, but then popping just right back up to 19,000. So if you're interested in trading that, you can obviously go to lower time frames and trade that actively if you want, or strategically if you get a break of 19,000 and you want to take a longer term short, you can do that. Just have your stop in case in case price pops up and takes you out of the position. But I mean, if you look at the PPO profile, all along this whole time, momentum has been improving and RSI has been improving. Now, and that's supportive of a move higher. Just keep in mind that these positive divergence can be burned through. If RSI were to turn down, PPO were to turn down, and price were to lose 19,000, then you kind of got triple confirmation that a break has indeed occurred. Tricky setup, but as we pointed out, I think the downside support is down around 13,000, 12,500, something like that. So getting this one right could potentially be really, really rewarding for you. So get your ducks in a row if you want to take a stab at this. And the way to do that is through, if you're not into futures, find one of the Bitcoin proxies that you like. There's a lot of ETFs out there, long ETFs, short ETFs, etc., that you can use to express an opinion, whether you want to be long or short. We talked about oil a little bit, firmly in this down channel. I think right now you got to look at these lows down towards 77.5, and if something positive were to happen, you've got a nice downtrend line here that if price were to break out, move above 82, and then take out 85, yes, you do have overhead resistance. You can see right here we've got a big value range, and we've got the declining 50. Well, you got the 20 right in here at 85. Then you got the 50 and the 200 to deal with. But the most important thing is getting the breakout out of this downtrend channel. And if we were to lose 77.5, notice you got a void in the chart. and then that would put you on the wrong side of the channel. You can see low side of the channel, high side of the channel. You break 77.5, then that opens the door for a tag of the lower part of the channel down here at 71, and then the midpoint of the channel will act as resistance on the way back up. Our short on Germany continues to move lower. We rolled down to the 19 strike in October, so that has effectively 2 weeks till expiration. Keep an eye on any kind of reversal if you want to, get out of it. This had kind of a hammer look, but then it kind of, this is kind of an important week. If you saw a green candle here, you might want to just cover that short. I want to see it move lower from here this week to remain confident in it. The oscillators are still oversold, so from that standpoint, favoring a bounce. But we've seen over the last several weeks, the bounces have been very short-lived, and as soon as they, have a morning session or a day of positive price action, that they've been reversing it. Same thing with McClellan, just not quite as exaggerated here, down at minus 47, kind of stretched to the downside. I think the door is open if they wanted to push this down to make another, get it really overextended again. That possibility is certainly there. So now what I want to do is jump over to the weekly charts to give you an idea where we're at. We have been saying for quite some time, keep those pre-COVID highs in your mind and on your chart as potential targets for equities, no matter if that's an index or an individual chart you may be trading. So here we are in the SPY weekly. Bearish look on RSI. Weekly chart just put in a bear cross below the zero line, which is bearish. And we made a new low, not by a lot, but we made a new low down here at the final close, 357. And you can see right here we're on a support ledge on the weekly. And if we were to break 357 to the downside, and we can't recover that level, then we move into a void on the charts. We do have a line of support here at 340, but that's $17 lower. This price scale is very compressed, so there's a lot of dollars involved here. And then our pre-COVID high was down at 320. So I think it's really important technically to put in a green week this week. Otherwise, you break this and then that opens the door to 340 and potentially even 320. Moving on to the Qs. Same kind of look on our indicators, trapped in the bearish regime in RSI. We just put in a bear cross on the weekly on PPO below the zero line. That's a bearish look. We did make a new low in price on Friday, and you can see we're coming up to a really critical level. Why? This is the low end of value. You can see, the distribution of volume over price here from 360 on up to, 260 on up to 360. You lose 360, and then you move into a void, and then there's your pre-COVID high at 230. So you break 260, that opens up the door to 230, and then that could potentially be like your panic type move if this were to break this week, next week, and then make a really fast run towards 230. If we look at IWM, we're already there. Here's the pre-COVID high back in time, right here at 160. So I would be focused on 160 as long as it can hold above. The damage has stopped, but if 160 were to break, I think that would be really, really significant. Why? Because you're moving in below the pre-COVID highs, and then that opens up just a whole range of downside possibilities once you go back into an old trading range. And if you think about it, anybody that bought anywhere in here, they're still fractionally positive. But once you lose that pre-COVID high, then anybody that bought this breakout is going to be underwater, and then that would be a signal that all these people are, of course, wrong. Moving into the other SPDR sectors, materials. Our pre-COVID high is all the way down here at 58. We've got some intermediate support levels at 67 and 64. I would have those marked on your charts. And if you're interested in, doing any kind of a trade, have those levels alarmed. And from a technical standpoint, price really needs to get back above this high volume overpriced bar here at 72 and change. Come back here, and then that would be your bear trap, right? New low, got your sell signal here at 70, and then recover that, and then that would be your bear trap. But a lot of work to do to make that happen. And with PPO heading out of town, RSI heading out of town, the indicators certainly favor lower versus higher. Communications, really rough shape. Why? We're already below the pre-COVID highs. Really, the only thing that's left is the COVID lows. And remember, this is the sector that's 44% Meta and Google. So if you go to those charts, you'll see that that those two are in particularly rough shape. So we've already lost the pre-COVID high. COVID lows are now in the crosshairs. It's got to hold 47.5. You can see that the volume over price profile falls away. That would open the door for a fast $10 move down towards 37.5. Should we encounter a bunch of turbulence in the weeks ahead. PPO really weak, putting in a bear cross way down here. RSI hasn't shown any signs of life, so those two are supporting lower prices. Energy has held up, relatively speaking, very well. We got the pre-COVID highs back in this area around 55, where you see we've got a value area from 45 to 55, and we're sitting on a line of support right here. You see the large volume over price bar right at about 71, and we've got the 40-week EMA at 71.50. So that could be a really nice pivot point for you on your trading on XLE, because you're right at the 40-week EMA. And if you go back and look at the other charts and identify where that 40-week EMA was, same thing as a 200 EMA on a daily chart. Once you lose the once you lose the 40-week EMA, that's definitely a bearish signal. And that accompanied with the oil chart should give you some really good cross-referencing to do if you wanted to take a long or short position in energy, depending on what happens. If you get a breakout of that oil channel to the upside, then your equities should follow. And conversely, if you get a breakdown, then you would have a really nice line to shoot against on the short side on XLE. You lose 71.50, then you got 65 that comes up fast, and then you got a big void in the chart from 65 down to 55, where that could be a pretty substantial trade if you were to get that right. Now on the indicators, you can see how important this level is, because RSI is hovering right at the 50 level, has not yet dropped down into the bearish regime. So as it stands now, support is support, right? And also on PPO, it has turned down, but has not yet moved into the bearish regime. And if you were to get a move down in RSI, PPO dropping below zero, and the price losing the 40-week moving average at 71.50, then I think you've got a very objective short on XLE. And remember, XLE, for all intents and purposes, is ExxonMobil and Chevron. I think that's about 47% of the index. If you wanted, higher beta, then you'd have to go to, your individual oil names for that. Financials, we are sitting on the pre-COVID high, which goes back right here at 30. And you can see that a break below 30 would open up 27. And we've got a gap to fill down here. And you can see the COVID lows were way down here at 18. So, but we're right at that juncture where a break below 30 that sticks this week opens up 27 to the downside. So right now, I think it's pretty obvious that you don't want to make a lower low on financials this week. Notice the bear cross below the zero line and RSI trapped under 50. Really critical spot. XLI looks a lot like a lot of these charts look very similar, but the point here is we've got a pre-COVID high at 80, and then the next big level of support, you do have a little bit of support coming in here at like 74, 75, but then you've got a larger volume over price bar here at 68, let's say. what I would probably do here is, well, you've definitely got a pivot point here at 83 at these lows. You can see those lows were tested quite a bit. But if you got a break below, then I think you come down to these pre-COVID highs at 80 pretty quickly. And then that will be a big, big test. What you may want to do is say, I'm not going to try to get too cute right here. And I would take a short if it broke the pre-COVID highs at 80. So in other words, give up these $2. And then if it can't hold here, there's probably a lot bigger fish to fry on the downside. So you'll have to decide how fine you want to trade industrials, given that this important level is so close. XLK, still pretty far above the pre-COVID high, down at 100, but we had a bad break last week, and so now the door is definitely open. Below 126, the door is open towards, like 107.50 down at that range. And unless and until price can recover this 126, I would be leaning to the short side on technology, on XLK. And this is Microsoft and Apple are the big drivers in this particular index. You got a bear cross here, and you got really weak RSI. So the indicators are certainly favoring a move lower. Staples have been getting hit, coming into a level here that's really important at 66. If you were interested in trading that, I would have an alarm there. And you can see the pre-COVID high is 60. Doesn't seem like a lot, but that's basically 10%. $6 out of 60, so that would be a significant move. And the thing I want to point out here, your safety names, in general look better than a lot of other sectors. But what's happening is a lot of people buy those staple names because of their healthy dividends. 3.5%, 2.8%, whatever it may be. But now you can get 2-year treasuries at 4.25%. Why would you take equity risk when you can get why would you take equity risk to get a 3% dividend when you can get 2-year money, no risk at all, for 4.25%? So now what's happening is these defensive names are getting competition from the treasury market. Same thing with XLU. A lot of people in there for the dividend. You can see that that's worked well coming out of the COVID lows. But last week, bad week at the office, down 8%. That is a massive amount on something like utilities. And now we're coming in to these pre-COVID highs at 64. That's got to hold. It's really, really clear. You've got lows here, lows here. You had a breakout here. It dropped back, but now, broke back out again. So, but if you lose 64, then you're really in the soup, and this thing could come, once it loses the pre-COVID high, then who knows where it might go. I think your first stop would be towards 60, and then potentially all the way down here towards 54 on utilities. And again, that's, I think, mainly driven by competition from the Treasury market. XLV has been holding up really, really well. We've got this $12 wide trading range. We've spent, God, what have we spent? A year and a half toggling, bull trap, right back down to the bottom of the box. We went to the top, back down to the bottom, and then last week we had this little break below 122.50 down to 121. Now I think what you've got here is you've got an objective short with a stop nearby. With the $12 trading range broken, your measured move target is going to be 110, right? $12 from 122.5 is basically 110. You've got a little support here at 115, not a lot, and your pre-COVID high is way down here at 100. So what you could do is initiate a short against 122.5 with a stop just above, and see if you don't get a move down. Notice that PPO put in this bear cross right at the 0 line. That's a bearish move, and also RSI has moved below 50 down into its bearish regime. And then wrapping up with XLY, we had come down. We didn't quite get to the pre-COVID lows in June. We had a lot of tests right here at 136, and so now 136 is in the crosshairs, and then 130 is your pre-COVID high. So there's a potential for a bounce right here at the June lows, but if it breaks that, then down to 130 to test the pre-COVID highs, and then of course after that, the next level of support below is down towards 110. So by showing you these weekly charts, I think you get the picture. I mean, it's been pretty obvious that the market has been really, really weak, and we're coming into some key price locations on the weekly chart that, if they're broken, could portend for even more downside. So I think it's going to be a pivotal week. I showed you quite a number of charts that are, they're like right there, and we'll have to see how it goes. And what I would recommend on your active trading or swing trading, start on the weekly chart and work your way down towards the time frame that you're trading. So for instance, if you're trading the daily chart, start on the weekly and find out what the big trend is on that particular stock. And then that'll give you a frame of reference for your daily swing trading, whether, if your weekly chart is in a confirmed downtrend and you're considering a long on your daily time frame, number one, it's counter trend, right? You're going against the main trend of the chart. And number two, where are the resistance levels where you would expect that rally on the daily chart to fail? And then you can, that would be a place to take profits and then flip short again to take advantage of the main trend, which would be down. So it's fine to take a counter trend trade. But when you're in a downtrend, you gotta realize that that counter trend trade is probably going to be short-lived, and probably a good policy to go to the bank regularly in case that trend reverses rather swiftly. So let's wrap it up there. Keep the weekly charts in focus along with your shorter time frame charts, and we'll see how it goes. This has been Chris Buss with Traders Profit Compass. Talk to you next time.